We bring in Tom Lee. He's co-founder, managing partner, and head of research at Fundstrat Global Advisors. And Quincy Krosby is chief market strategist with Prudential Financial. Hello to you both. So, Quincy, first of all, on what Dom was just saying about gold and silver have really done quite well here. And now with today more weakness in the U.S. dollar, more strength in the U.S. dollar. How do you expect that trade to continue to shake out?
Well, you know, you've got a lot of retail buying into gold. That could get shaky because remember, when you have retail buying of gold as opposed to institutional buying of gold, they're the weak hands. So any sense that the dollar weakens, any sense that the Treasury yields inch higher, or any headline, by the way, on tariffs that actually seems conciliatory could push gold down and get those guys out of that trade. That said, I would still have gold GLD in my portfolio. We've had that for some time as a hedge. It's geopolitical concerns. It is tariff concerns, equity selling off concerns, and one other. As we get into the fall, moving now, you have the ceremonial season in India. Indians everywhere around the world will be buying gold. Perhaps it's a little bit too expensive now, but they buy gold for the wedding season. It's retail buying of gold, and it's very strong.
And so, Tom, to Quincy's earlier point about there being a lot of sort of hot money in gold or in precious metals right now, where else do you see that phenomenon? I mean, what markets do you think are most exposed to a risk of a sudden shift here?
I mean, I think there are markets that kind of lit up this year. You know, gold definitely seems like one because it's been dormant for so long, and I think it is working as a hedge. I do think there's momentum buying behind long-term bonds. I mean, I think they've been moonshots this year, and it's incredible. And if U.S. rates fall further, you know, we could see some massive moves in U.S. Treasury. So I think that's another place where we're seeing momentum trades. But, you know, do these things still work if we have a resolution with China? I'm not sure.
Yeah, well, people don't seem to be. I mean, I don't know how you possibly bet on that outcome one way or the other. Have we gotten any new information in the last couple of weeks that tells you, Tom, that, hey, yes, we have to be nimble and be ready for some kind of resolution? Or to the point I guess was making last hour, does it seem like the president is in this for the long haul and is not about to put any surprises out of his hat?
I mean, I think the stock market is telling us something that's kind of interesting. I mean, you know, we've had some really negative and deteriorating and scary headlines, and the S&P's kind of hung in there. So I do think that there's underlying resilience in the equity markets. But, you know, I think the reason it's happening is, one is, you know, China is adapting to this through some currency adjustments. And I think U.S. companies are really starting to handle this through moving the supply chain. So I think maybe the damage to S&P profits isn't going to be as scary as people think.
As we, though, see the 10-year yield go to 144, 143, and possibly even lower, Quincy, I mean, is there a point at which you say valuations are not bolstered by lower rates, that there is a line in the sand, so to speak, at which lower rates mean bad things for the economy as well as stocks?
Absolutely. I mean, we'll get a better sense of it with the ISM service sector. We'll see whether or not that moves down below 50. It was hovered just above 50. We'll see about hiring expectations and new orders. If we see a deterioration in the labor market, hours worked even pulling back, you're going to see, I think, fears from that tug of war of whether recession, whether it matters this time, it doesn't matter this time, money coming into the Treasury market and pushing yields down further.
I mean, I would think, Tom, that the concern is that this all eventually hits the consumer, which has been sort of the engine of strength in the U.S. economy. So if manufacturing continues to contract, services then contract, at what point do you get concerned that 70% of the economy won't be there?
Yeah, I mean, I think consumers caught with sort of, you know, there's two headwinds and some tailwinds. I mean, the headwind is, of course, the confidence. And I think that every day they see these headlines about recession risk, it's going to make them cautious. But in their actual pocketbook, you know, lower interest rates means lower mortgage costs, lower debt service. It's stimulative. So I think lower rates in the U.S. is still good.
How many more people are going to refinance? How many more people are going to get? I mean, at a certain point, people who have refinanced and gotten those lower rates, they're not going to get lower rates, and banks aren't going to keep lowering rates just because the 10-year yield goes to 1.44%. They can't make money.
Yeah, just, you know, I mean, it was not even 15 years ago when people said it was a mythical rate to have a sub 4% mortgage. Now we have sub, you know, well under 3%. Yeah, and look, if rates get low enough, what happens if there's a 0.5% 30-year mortgage? I'm just saying, theoretically, I think it would have very big positive effects.
Yeah, well, I think the banking industry just fell out of its chair listening to that idea.
But as you know, in Italy, for instance, there was an article how the lower rates have really been sort of a source of wealth creation in countries that have seen consumers benefit from lower rates.
Quick last word, Quincy.
Yeah, one nice correlation for the market for investing is the lower prices at the gasoline station. Nice correlation with fast food. You go and fill up. You've got some money left over. You're going to go to the next drive-through. Maybe not walk in and exercise, but we're seeing that positive correlation. And gasoline prices are attractive unless you're in California.
Sure. Yeah, or unless you're in Houston on the other side of it. But you're right, fast food. So there's some place to watch.
Oh, yeah, absolutely. Yeah.
In this market. And they've done so well this year. Guys, thanks. Really appreciate it. Quincy Krosby and Tom Lee.